Right, good morning everyone. Thank you for joining us for another Aitken Partners Business Law Breakfast. Today's hot topic, very exciting. I've been awake since 4 o'clock thinking about this. It's not a lie, but I'm not really that excited as the topic is. Property taxes in 2024. My name's Julie Maxfield. I am the head of the commercial and property team here at Aitken Partners. Just a couple of quick things. We've got a lot to get through. We're trying to have today as interactive as possible, so please feel free to ask a question at any time. If you're on the webinar...
Are you sure about this?
No.
I hope you know the answers.
Feel free to put a question through in the chat also, and I think we might just get moving because there's a lot to get through. So we've got 3 great speakers today. We're doing a bit of a Q&A session. First in the hot seat, you've already heard from Rob Bradley. He's got more than 30 years experience in property and commercial law, solving specific, unusual and complex property matters, also as traditional property business and planning. Rob is the perfect person to update us on the recently introduced windfall gains tax. Rob will be followed up by Diana Lawrence, who has recently joined Aitken Partners commercial and property team. Prior to becoming a lawyer, Diana worked in various senior roles at Macquarie Bank and Australian Super, and she has a diverse range of skills, and she'll be answering some questions on the hot topic of recent changes in land tax and why is my land tax so high. Ralph Davies is our final Q&A guest. Ralph has been at Aitken Partners for just over a year. And he has a background in commercial and property law with dispute resolution experience. Ralph will touch on a change to stamp duty for commercial and industrial properties, which will commence on the 1st of July 2024 this year. We probably won't see the effect of it for a while, but it's something that everyone needs to know about and I guess prepare for in the coming years. But just before we kicked off, I wanted to just touch on a brief article that was in the Herald Sun this week, which is pretty topical about land tax on beach boxes. So some of the residents from Brighton down to Mornington received erroneous land tax bills from the SRO, basically based on the fact that they were the owner when in fact they were licensees. The article goes on to say that some of these bills were in the vicinity of $5,000. Oh God. Not sure that those people must own a bit of other land because the value of the beach boxes are quite low. But what I thought amused me about the article was it attributes a quote to Brighton MP James Newbury. So he says, "Jacinta Allen is such a dud premier. That Labor is charging people land tax for land they don't even own. Watch out, Labor will introduce a breeding tax next." So just on that note, Rob Bradley is going to talk to us about some issues with the windfall gains tax. So Rob, briefly tell us what windfall gains tax is and when is it assessed?
Okay, well, windfall gains tax, funny name that. I prefer to call it a rezoning tax. It's that easy to understand. But windfall gains tax is imposed when the capital improved value of your property increases by over $100,000 upon a rezoning. Okay? Some rezonings are exempt. The most important one is if your land is already in a GAIC area, or if it will come into a GAIC area as a result of the rezoning, then that's exempt.
What area, sorry?
A GAIC contribution, growth areas, infrastructure contribution area.
Which is another tax.
So you can't get taxed twice for the same thing unless, if you remember it's a rezoning tax, it can be rezoned twice. But that's it.
So who is liable for that tax?
So if the person who owns the land is liable, okay? And what's most significant about that is once it's been assessed, you can't pass it on to somebody else. You can't sell the property and say, hey, you pay it. Once it's been assessed, you're stuck with it. That's a potential trap for farmers, particularly who own properties. They sign up a contract and just don't think about windfall gains tax, rezoning tax. They sell their farm for a massive $35 million. Fantastic, fantastic. But between the date of the contract and the date of settlement, it gets rezoned. It's now worth $100 million. There's a $65 million increase in value, and you pay tax on that $65 million. And as luck would have it, on the calculation that was done in my head, you'd be left with 2.5. So it's a potential trap of significant proportion.
And I think that's a change from the 1st of January this year, that you can't pass that tax on to a purchaser in a contract. So
Correct. Yep.
Can you pass it on to tenant?
Great question.
Now, I didn't
Come
make
back
the
to me later.
I don't think I made the rules
If
quite
it's-
clear.
if it's
Tricky
in a
questions you have to write down and give them to me half an hour beforehand.
But I'm assuming that's only if it's been assessed. You can pass it on.
There's no reason why you can't contractually get somebody else to pay for it other than a purchaser under a contract of sale. You can have a contract with your mother-in-law to pay it if you like. I don't think she's got enough money, but
But she wants to pay it, by the way.
But could you, I'm assuming that's only if the assessment had already been made.
yes.
So
yes.
if it got assessed between the period, could you contract to pass it on?
If your contract says you, the purchaser, will bear any windfall gains tax should it be imposed, you're fine. But if it's already been imposed, already been assessed, then you're stymied. Yeah.
What's the trigger for it? Is it an annual assessment like land tax, or is it
No,
some sort of
it's
random-
if the value of your property increases as a result of, or if your property is rezoned and the value of your property increases, the capital improved value, not the site value like land taxes, the improved value of a property increases by more than 100,000, you're liable.
But is that increase triggered by the fact of the rezoning?
Yes, yes.
Or the fact of some other assessment?
No, just rezoning. And what
The effect of
the way in which it's assessed is that there's
which was my next question, Rob. So
spontaneity. The way in which it's assessed is that you do a comparison between the capital improved value shown on your last municipal rate certificate, and the valuer general comes in after a rezoning and does a revaluation, and they're the two figures.
So technically, if there's no improvement on the land, there's no.
That's fine. That's fine.
So it's a
Now-
one-off tax.
yeah, and one off type per rezoning.
Yes. And what do you do if you receive an assessment, Rob?
This is deep legal advice. This is check it. And particularly because this lovely piece of legislation says if there is a mistake, an error or an omission, you're under an obligation to tell the government they got it wrong. So if they've left out a bit of property, or there were two properties that have both been rezoned and they've only got you for one, your obligation to tell them. And penalties apply, of course. The other aspect of that, the other thing you should do after you've checked it, is you should have a think about it and consider the possibility of getting your own valuation. The Valuer General's word isn't the final word. You can appeal it to vacant. And in the land tax area particularly, I mean, there's been a lot of successes with clients taking valuations to vacant and working on them. And significant reductions in the amount payable. So, depending on the amount and your own view about whether or not it's plausible, what they've said, probably get a valuer to come and have a look at it, and if they think it's got legs, do a proper valuation and consider challenging it. There's probably a 60-day appeal time limit. I'm guessing 60, but that's could be 30, 90.
So when you get the assessment, when is that payable?
When they assess you. Actually, I think you get 30 days of the assessment. So that in the example before, when you're asked to come up with your 35 million within 30 days, and you've just had you're a farmer. I can ask some of the farming people here that if they've got 35 million in the back shed, but I'm guessing I don't know the answer to. So, but there is a chance to defer it. You can apply to defer it. You can defer it until the next dutiable transaction, a sale, or if there's a change in the interests in the property, then that would occur, or up to 30 years.
If you defer it to, let's say you were selling a property, do they then charge you interest on top of that?
Funny you should say that, of course. The government bond rate, currently 4.71% would apply. This is the other really good bit of news is if your property is rezoned and it's now worth 75 million and you get assessed on that uplift and you defer it for 15 years, and the value of the property goes down, say down to 15 million again.
Still gotta pay.
You still got to pay the amount that was assessed,
Oh, wow.
plus interest.
So is there any exemptions, Rob, for instance, for residential land?
Yes! I'll come to you in a minute.
Sorry, did you mention the rate in the dollar that is assessed for that taxable amount? I didn't.
Oh, sorry, I'll go to this question first, then yours, if that's all right.
Okay.
So, first $100,000 increased value, free. Between 100,000 and 500,000, 62.5% of the uplift.
62.
62.5. The government's website describes this as fair. And I think that's because once you get over an increase of $500,000, it's only 50% of the uplift. Of the uplift. So, Jules, your question was?
Any exemptions for residential land?
Residential land under 2 hectares is exempt. That doesn't apply to commercial residential. It doesn't apply to retirement villages, nursing homes, etc.
Changes.
So one thing I guess we haven't quite touched on is how do you check if there's an assessment? So when you get your due diligence for a purchaser or client and you're getting a land tax certificate, the windfall gains tax certificate also comes up with that land tax certificate now.
If it has been assessed, yes.
Yes, if there's an assessment already in play. And just a few final words from Rob. What's the justification for the tax?
I was waiting for this. As I said, the state government website says that this is an efficient and means of, I'm trying to think of the right word they used, it's taking a fair share of the increase in value as a result of the rezoning. And what I find interesting in that is that the state government wants to take credit for rezoning the land and for causing the uplift in value. And that strikes me as weird, because the only reason the value is increased is because the state government is removing a restriction that they previously placed on the land. So they've done something to you and they stop doing it to you and want the credit for it. Which I have a difficulty with that, but it might just be me.
Have they reported any forecasting of their revenue increases?
I don't know, to be honest. The other interesting thing, you remember I've referred to it as a rezoning tax, whereas the government chooses the pejorative term windfall gain. Now, I've advised a couple of farmers who have worked their land all their lives, probably on fairly limited incomes, persevered, all of the farmer stories, hail, drought, whatever, so forth. But their reward for their hard labour is the knowledge that eventually they'll have a nest egg, they can retire and sell the farm and retire. Not one of them is referred to as a windfall gain, but they see it as a reward.
Yeah.
That's just me. And often it's going to be the developers who will initially bear the brunt of the windfall gains tax, and they'll pass it on to the purchasers, including the first-time buyers who are already struggling with the cost of the. So capturing is what they say, capturing a fair share, and we've spoken about 62.5% and the change in values and so forth. But the really good news is that it's our state government. So you know that every cent that they raise through this tax will be spent wisely, not a cent will be wasted.
Thanks for that.
That's my political comment just for that.
Does anyone
The other interesting comment, you talked about Victorian government, of course, there's a capital gains tax issue at federal level. As an accountant, we're grappling with the fact that whether that windfall tax paid will in fact form part of the cost base. The tax office remain quite silent.
They are silent. That's interesting. That was one of the first observations that we made, was that surely the federal government's going to object to this because it'll reduce the amount of capital gains tax that they collect. But who was that famous boxer, the left-hander to get you the right will? There was a saying along those lines.
I wasn't born then, I don't think. Well, thanks very much for those insights, Rob. Next up in the hot seat is Diana. As I mentioned, she's got the most topical issue at the moment, I think, in increases in land tax. I think the main reason it's topical is assessments have started issuing from the SRO for this year, and a lot of people are receiving severely increased assessments or an assessment for the first time. So just one of our little tidbits, I guess, back to our farming friends. A lot of our farming clients are receiving land tax assessments. So they've been using their land for primary production for 100 years. Next thing, land tax assessment pops up in the mail, because my understanding is State Revenue Office has drones that go around and check what people are using properties for. So if they don't think that you're using your property for primary production, you need to then pay the amount in the assessment, which as a farmer, obviously generally you are asset rich, cash poor, then you have to object. And we had one recently, I believe, a client of ours got an assessment in the $100,000 mark. They had to pay it, never had an assessment before, objected within the relevant period, which Diane will touch on later, but they were lucky, fortunate I would say, that their objection got looked at really quickly and they got a refund straight away. But we've also seen timeframes of 1 to 2 years for looking at objections. So
Do you have to pay first and object later?
you do have to pay in accordance with the terms of the assessment. Yeah. So Diana, what is triggering the avalanche of changes in the land tax arena?
The government's debt. To put simply, by far the government took quite a bit of debt out during COVID. An interesting stat also, I guess, during COVID, less sale of homes, so less stamp duty. So the government's revenue actually decreased from previously in 2022, 10 million stamp duty down to 8 billion. So land tax was a way to recover that. So I would say primarily, although I'm not taking a political stance either way, it is definitely a revenue raising exercise, a lot of these changes. A lot of the changes with respect that we'll touch on for the vacant residential land tax is driven by the housing crisis. By far, some I would say a bit of housekeeping and fairness, and I'll go through the fairness one shortly, but yeah, by far it will be revenue raising if I'm honest.
Yeah, and do you want to outline for us what are the main changes that have come in?
Certainly, the biggest probably change is the threshold tax. I'll use the word tax-free threshold because we're so used to that income tax. So prior to the change, if the value of the site value, so the unimproved value, was less than 300,000, no land tax. That threshold has now decreased to 50,000. Does anybody want to guess how many new assessments that now will trigger this year alone? Not you. I'm happy to give a lolly, and I'm sure I have one in my desk. Just rough, I was surprised by how many.
Well, how many properties are actually worth that?
That, yeah, but I was...
It's the site value, it's
Site value
so every
land.
high rise
Yeah.
is probably each apartment and so forth.
Yeah, so
yeah.
A million?
a bit high. It's actually, the State Revenue Office is estimating at least 360,000 new assessments. So this, to Julie's point earlier, there's going to be clients that will receive a land tax bill for the first time ever. And that's primarily going to arise due to the change in the threshold. That was one change. And probably the second change is the rates of tax, the revenue raising have increased. Generally at each tier by 0.1%. There's also been changes to the surcharge rate of tax for foreign investors. So the maximum rate of tax now payable under land tax is
4%.
yeah, no, 6.65 you could be up for if you're a foreign investor.
So could you just, I didn't quite hear that.
Sorry.
So the rate of tax is increased by an additional 5.1% across each tier?
No, so by 0.1% across each tier.
Thanks.
Thank you.
Can I just, in the 50,000 to 300,000, what's the rates in there?
I thought you were going to ask me that, thank you.
We rehearsed well.
You did. So between 50 and 100, it's $500, just a flat figure. Between 100 to 300, it's $975. Then from 300 to 600,000, it is 1,350, and for anything over 300, 0.3%. And Julie and I do have an example shortly.
And that's just for individuals, so as
Yes.
with everything, there's a surcharge for trusts.
Thank you.
Things like that. So our example, Diana, is what does the increase mean for a person with a holiday house in Portsea?
You know, I won't swear, but I'll just say a lot more tax. So we just, look, land tax is on the unimproved property value, but we just thought we liked to use a bit bigger figure. But having said that, the median house price in Portsea is the lovely 3.255 million. I'm sure you probably can find land for that down there too. So their tax bill for 2024 will go up from 38,000 to, will go up from 34 to 38, so a good additional $4,000.
That is in person land.
So yeah, a lot more tax.
And one thing, obviously, I mentioned earlier is we're seeing people receiving land tax bills that when they haven't previously. So what do you suggest they do in those circumstances, Diana?
I think, and it's not just because we're lawyers and we like making money, get advice. Julie really touched on an interesting point about the data mining capabilities of the SRO. And that's really scary. So clients think, oh, how do they know this? How do they, it's scary. So I would say by far get advice, do it within the time frame, it's 60 days from the date the notice is received, which is interesting. We always take it from the date it is issued. So yeah, definitely get advice. Because also be mindful what you say. You know, we have had clients try to do it themselves and get caught up and said something wrong and then cause themselves a lot of grief. So, I think also another thing, not only, object to the land tax assessment notice, but also to your rates, which has the site value as well, is another avenue.
So I think that's part of the objection process with the State Revenue Office. You can object to the value from the Valuer General, but you can also object to the value on your, which is the same value that will be on your rates notice through your council. So if you think your rates are too high, had a client, I think they purchased a property recently for, it was a considerable amount, say $1.8 million, but the rates notice says it's worth 2.8. So the first thing they were about to do was object to the value on.
Have they got access?
Oh, sorry, don't know yet. But Andrew Blogg in the room, he's got experience in rating objections, so.
Well, there's lots of time frames to kind of tricky and often conflicting in the act. So you get advice, legal advice, but also valuation advice important.
So next,
Sorry, Julie, I've just got a question online, and it might be, you might want to hold it as a commercial question, but we've seen a commercial property change in valuation from 2.67 million in 2023 to 8.2 million in 2024. Is this common for commercial property?
It's common to see, I think, an uplift, but that sounds very excessive.
Yeah.
Unless it's rezoning.
Then you got double.
Yeah, so that's something I would definitely be looking into, yes.
Can I ask, if you are going to object to a land tax assessment, what is the best way? Get real estate appraisals and also a valuer, or?
So in terms of the actual value, not the reason for the assessment, you just mean the value?
The actual value.
Yeah, get your own, evaluation is the best thing to do.
It costs more money.
Yeah, obviously, so get agents' advice, get supporting documentation to submit with your
Can you
objection.
ask for their documentation as to why they put up that?
So their documentation, their value comes from the Valuer General. So
Can you ask for their documentation?
Julie, I think what most councils are doing now is outsourcing, and really it's a desktop valuation. Yes, it'll cost you money to get your own valuer, but if you take it to an appeal, and if you take it to a settlement in discussion between valuers, one of the things that they will pay is the valuer's fee. So there's a fair chance if you're successful, you'll get that back.
And what, have they got the right to, say if you objected and they came back and said, actually, we've decided it's worth more, can they do that? Go the other way?
I love these questions. My thinking
Well, it
is
seems
that
they make up the rules, so, you know.
my thinking is that they can, but I'm
I've
not
seen
sure.
it done
Those
once.
cases
I've seen it
rather
done.
than
Shall I get legal
case,
advice on
they couldn't do that.
After it got to the tribunal, they couldn't do it, but before then they
I think
could.
it's been appealed as well.
If you're running a superannuation fund, you're required to get small valuations, I think every 3 years. Are they adequate to be used as your basis?
Absolutely. The process will be you lodge your objection and say why, and you'll probably give a copy of your valuation. The person on their end will look at it and say, oops, he's got a point. Or else there'll be a meeting of valuers to discuss it, and together they'll come to an agreement.
So I've already paid the land tax that I've received this year, but I do think now that I'm listening to you, that one of these is overstated.
Time limit.
60 days.
You've only just got your assessment, you've got time.
Still got time even though I've paid it.
Yep. And look, the thing about paying these things is that if you don't pay them, then and you lose, you'll get interest charged against you.
Only after 60 days though.
After it's due for payment.
Yeah.
And will she get interest back?
No.
Sorry, if you lose, you don't get your interest back. No. That's because you haven't paid.
If you win.
If you win everything you've paid, you'll potentially get back. Yeah.
Yeah, so my understanding is you should get interest back, but again, we saw one recently, client had waited nearly 2 years after lodging an objection for about $80,000, no interest was paid back, so.
But you would get your cost of valuation back.
Yes. Normally that would be part of the settlement, and if not, if they have an obligation once it gets to the tribunal to justify their valuation. If they don't justify it by $1, it's wrong.
Yeah.
And you win. You win $1, but your costs.
With that example about the holiday house reports, my husband and I always joke about getting divorced for money tax purposes. But in actual fact, what is the position if you have a couple and houses in different names?
I've got a great example. I had a couple exactly in that scenario, been together for 15 years, never married, she was claiming her principal place of residence on one, and he was claiming the principal place of residence on another. And that was going around really quite nicely until COVID hit. She changed her driver's license. Okay, so changed driver's license. She tried to argue, but I still, this is my primary principal residence, I sometimes go there. Data mining capabilities. What do you think the State Revenue Office used to show that it wasn't her principal place of residence? Utilities. They had access to her gas and electricity bills, and it was just none. She was only paying the charges. So
just off the back of what Diana said, there are requirements obviously that need to be fulfilled if you are saying it's your principal place of residence, but you can't just say, the husband lives here and the wife lives here.
Too.
You have to actually use it as your principal place of residence, and I think it's 6 months from the 1st of July every year. So you can't say you live there if you don't, essentially.
They'll find out. Yes, so
And so they actually look closely enough to make
they looked, and it was really interesting because she also argued that her son was residing there as well. And the usage was she was lucky if she was, how on most utilities it's usage and charges.
Yes.
It was just predominantly charges, not usage.
How far back did they go?
They went back.
6 years?
They can go back 5 years.
5 years, yeah. But I think for this one, I think it was 3 years.
So she wasn't even renting it out. She just wasn't actually with us. Oh my god. Tough. Yeah, that is
Yep.
I've got a bit of an unusual question. I've got a piece of land with not a proper house on it. So, what if I went there and lived in a yurt or something like that? Can I still call that my principal place of residence?
The
It's got
residence
water
on
and
it needs to be
electricity.
habitable.
A yurt's very habitable.
Yeah, so
No, it's got to be defined as a dwelling.
it has to be a dwelling that's habitable, or there are also exemptions where you've demolished a house and you're rebuilding, or renovating as well. So there's a period within which you can claim the exemption based on that as well.
So the main exemption is principal place of residence? What else? What about for a charity that owns?
Yeah, there's charity exemptions.
So it has to be used for a charitable purpose. So just because you're a charity doesn't mean that you get an exemption from land tax. It's based on the use, whereas some other taxes are based on the actual organisation. So there's other exemptions. So primary production, sporting or cultural land, residential care facilities, retirement villages, health centres, that sort of thing.
Yeah, for the land tax, some of the commercial side was the tenant paying for the land tax. Does tenant can or still pay for the increase of the land tax? Is that including the absence, the overseas?
I'm assuming this is a commercial, so not doesn't fall under the Retail Leases Act.
It's not like
Yeah, it's a proper commercial.
Yeah.
Yeah, then it's
Yeah, pass it on.
pass it on.
I'll pass it on.
As long as it-
if
yeah.
that's what the lease says,
Says,
I guess.
yeah, the
So the
agreement.
lease might say they pay the if it was the only property that the landlord owns, but if it just says that they have to pay any land tax assessed, then yeah, you could pass it on. We might keep moving just because we don't want to leave Ralph hanging out.
You can skip me, that's fine.
So vacant residential land tax, what is changing there?
Yep. I'll just explain what vacant residential land tax is first. So it was introduced in 2018. In the event that a residential property is left vacant for more than 6 months, a 1% tax is payable. This is in addition to the land tax. The general rate.
As of what date? Oh, sorry. This year?
No, so this has always applied since 2018.
In certain municipalities.
So
there's
in a
change.
city, yeah. So the changes then, so what's now occurred is so it really impacts us this year, is if the property, any property that's left vacant for more than 6 months, regardless of its location, and can be primarily or solely used for residential purposes, is now caught. So the scope is caught, as opposed to just being certain properties in a city. The scope has increased, and so has the rate of tax. So the rate of tax has gone from, for the first year, it's going to be 1%. If it's left vacant, then the next
Which is
year.
of site value?
Very good question. You know that answer, and I
What
do
was the
too. What is the rate of tax applied on? Does anybody know? Is it the site value or the capital improved value?
Must be capital improvement.
Exactly. So it is quite a bit. So it's, as opposed to land tax is on the unimproved value, vacant land tax is on the capital improved value. So it's going up first year, 2% next, second year, 3% the year after.
And then?
It's at the moment. Can I say at the moment? That's it.
And I think recently there was an article, Diana, in the Herald Sun that said the Melbourne City Council was mooting an increase to 10%.
Jeez.
Yeah, yes. So that scared both Julie and I. But it was the Melbourne City Council put it to their one of their subcommittees and said, look, for vacant properties, we think that the rate of tax should be much higher. It should be up to 10%. Now, vacant residential land tax is a state tax, not a council tax. So it's something that they want. A spokesman from the government has said, look, we saw what their proposal was, but at this stage, there's no intention to increase it up above that 3% threshold.
Are there any exemptions if you've started a planning process on that road?
Yes, so there are kind of special rules about, if you started construction, generally from the date of planning building permit, you've got 2 years.
What's the definition of vacant? Is it for 1st of January to end of December?
Yeah, so the vacant period is assessed. So for the 2024 period, we're going to be looking at tax year. We'll be looking at from 1 January to 31st of December 2023.
So if you've got 1 day leased out, it's not vacant?
No, so it has to be 6 months.
Okay.
has to be not vacant for 6 months, and that could be on an aggregate basis, or it could, so let's say you had a short-term lease for 3 months and then a vacant for another month and then another lease for 3 months. As long as the collective time it wasn't vacant was for 6 months, you don't fall under that rule.
What if people using it as a holiday house in Port Sea?
There are holiday house
I
exemptions.
knew you
though.
should ask that.
Thank you. Does that tie in with Airbnb properties as well?
The 7.5.
No, that's again, that's something a little bit different, and the 7.5% was something that was just tabled in the.
It's not legislated.
No, it's not, and that's really more at a platform level. Nothing. So I would
whatever.
park that one completely at the moment, if that's all right, because that hasn't been put into force at all. To answer your holiday home question, holiday house question, so provided that you've occupied that house, that holiday house, at least for 4 weeks during a year, you're
Not 6
fine.
months.
Yeah, not 6 months.
Nice to be there then.
And it has to be the owner. And the other test is, which has caught out, I know one of my clients was, you also have to have a principal place of residence somewhere else in Australia.
Okay.
So,
What about like when you're talking holiday homes, like there's some change in regulations that you can put granny flats, or what about pods? You know, there's fantastic pods, you know, like tiny houses that now you don't need permits. Does that classify if you lived in that for 4 weeks, if you've got a pod?
I guess it comes down to the question, is it habitable to
Yeah,
Julie's
and
point?
are you
I know
using
it's
it
habitable.
for your
I know.
holiday house for
No, I think it's
four
what the
weeks?
council
a year?
defines as a dwelling, and all of them are different. Each council defines it differently.
So the best thing is to go and see a town planner at the council.
With that kind of thing.
Yeah. There's a lot of confusing, conflicting things.
Look, and even when Julie and I sit down,
So has that scope from Melbourne, how far has it gone? Does it include the whole of the peninsula?
all Victoria.
All of Victoria now. So I've got some vacant land on the peninsula, and that's going up as of
Vacant
next-
land, so vacant land is a bit different. So there is a change, and so I haven't touched on that change yet. So what I was talking about, that is residential, that is,
Holiday home.
or homes that can be resided in.
Oh,
There's
okay.
those rules.
My understanding, and Rob and I have chatted about this, the Act it talks about primarily or solely
Solely.
used for residential purposes, and the Act doesn't really define what that is, but the State Revenue Office has issued some sort of guidance about that, and our view is that it needs to have a house on it, so it wouldn't apply to vacant land.
So the increase won't apply to vacant land?
From
Completely
1
vacant.
January 2016, there's a new rule. 2026, did I say 16?
Going
Sorry.
backwards. Oh my God.
Apologies, 2026. There are rules changing for if unimproved land has remained vacant for more than 5 years, tax will apply.
How much?
I think that's around the same kind of thresholds, the 1, 2, 3.
5 years backwards or 5 years forward?
5 years, yeah, so 5 years. So the tax will be start payable from the 5 year mark that it's remained unimproved.
After 2026?
Correct.
So 31,
31, yeah.
Oh, you've given me a little bit of a
We will keep moving.
Yeah, sorry.
So what you should know, what should people know about if they don't pay their land tax?
Interest is payable, and Julie made a good point earlier that historically we could have kind of argued use your discretion. Very hard now to get the SRO to use the discretion in this space. They're more inclined now to get debt collectors involved. Julie even had a case where it was as low as $600 and debt collectors were involved.
And that was just 1 year's assessment, so that was last year's assessment, I think. So they're using collection agencies.
It is a charge against the property, and not only is it a charge against the property, it rates, from a priority perspective, it even rates above mortgages. And if you don't pay, they can come after your lenders and the like. So I think my point would be is pay and then dispute.
So I guess one other thing in that regard that we've seen is with companies, the State Revenue Office are issuing statutory demands. So if the land tax is not paid within the time frame, they've got the option to take steps to wind the company up. So
We've seen that.
we've seen that actually on a number of occasions recently, so it's a bit
What if you've got nothing in the company?
Well, I guess, yeah, that's a different story, but, yeah. And so I guess lastly from Diana, before we finally get to Ralph, very patient, what should people do to prepare for the changes?
I think definitely get all your contracts of sale of land reviewed, particularly, you know, with the windfall gains tax, who's liable, when, you know, particularly if it's, you know, there's a possibility that might come into place, you know, just so there's no surprises come settlement day. I think, yeah, planning, if you, we've got, Rob and I have both got a client who's got a big property worth quite a few million. You know, how do we plan for the, you know, GAIC or windfall gain? Either how do we incorporate it? You know, it's the more you know, you might, if you can't get it in the contract sale, include in the purchase price, so you're not left with the $2 million from a, what was the sale price? $100 million. So planning, so you know what to expect, I would say, and planning often requires getting a bit of advice.
All right,
Thank you.
Last minute questions, I'm getting told
Just,
no.
oh, just one. Airbnb, have you got any?
So
Can we come back to that at the
yeah,
end?
can
Sorry,
I? And
we're
yeah,
just on timing. We
Yeah.
need to get to Ralph.
thank you.
So Ralph is out, finally got there. He's going to touch on the new commercial and industrial property tax, which is proposed to come into effect from the 1st of July this year, which is a change essentially to stamp duty on commercial and industrial properties. There's not a lot of information around about what is going to happen, and it probably won't have a practical effect for some time, but obviously purchasers, financiers, landlords, everyone needs to know about that if they're looking to buy a commercial and industrial property in the future. So Ralph, do you want to give us a bit of background about why the government is taking the approach it is with the abolition of the stamp duty?
So I'll run through this pretty quickly. I know there's a lot more pressing questions on interesting topics. And without any political bias, I'll say that the government intention really is, at the moment when a company or business is looking to expand, they have that capital hurdle of paying stamp duty on commercial and industrial properties. So by paying that, what's happening is companies are discouraged from expanding their operations or investing that money internally, which is somewhat limiting their growth and productivity. So the government's intention now is, by taking away that capital hurdle, companies can look to find attractive, commercially sensitive properties that'll suit their business, rather than having to consider, how much stamp duty will I have to pay for this expensive parcel of land. They can reinvest that capital internally, and in the end, the government is hoping that what will happen is these companies can grow and employ more people in the workforce, giving the commercial industry in Victoria a little boost in the coming years.
And I guess one thing that we should make clear, and will come as no surprise to anyone, while we say they're abolishing stamp duty, they're replacing it with something else. So, how will the commercial and industrial property tax apply?
So exactly what Julie was saying, they of course will need their money back somehow. So what will happen is, from the 1st of July 2024, if a commercial or industrial property is purchased, the purchaser will need to pay stamp duty one final time for that particular property. Now, when that property settles, a transition period of 10 years will start. Now, within that 10-year period, the commercial and industrial property tax won't apply, and likewise, if that property is sold at a later date, stamp duty won't apply either. So, and I'm sure a lot of you are realizing now, what's going to happen is there's going to be a lot of particular properties, commercial properties in Victoria, at different stages of this tax reform. And another point that might happen is it might change the commercial property market somewhat. So, for example, if there's a commercial property that's being purchased and they've paid their final stamp duty, and it's within that 10-year transition period where commercial industrial tax isn't owed, that's going to be a very attractive property for companies to purchase. So there's a couple of considerations to take into account, but the main point really is it's a slow transition. So you'll have to pay stamp duty one final time. 10 years, there's no industrial property tax, there's no industrial or commercial tax owing, and then after that point you will have to pay that on an annual basis.
And Ralph,
I'm not really clear on the time frame. So say you're looking at a property right now, which we are, and it's a commercial property, and they say it'll be ready for occupancy in July. They say that the final sign-off on the occupancy will happen post 1st of July 2024. So if we contract to buy that after that period, will there be stamp duty payable?
So, yes, so if that property transacts for the first time after 1st of July 2024, one final stamp duty payment is owed, and then after that final stamp duty is paid for that particular property, after that point, it won't be due ever again as long as it retains that commercial and industrial purpose, for that property.
Is it when the contract's signed or when settlement occurs?
Settlement.
Settlement.
So when it transacts. So when the property settles, that's when that timing starts.
Thank you.
So what are the advantages and disadvantages of settling prior to 3rd of June? So I buy a property today, do I settle now or July? Do I wait till July to buy it?
Well,
What's the pros and cons?
so if you settle, let's say you settle now, you settle today, you're going to have to pay stamp duty, tax legislation stays the same. Now, if you settle after the 1st of July, you will again have to pay stamp duty, but then you have a 10-year leniency period where you don't have to pay commercial industrial tax. So there's a few considerations likely people on a case-by-case basis will have to consider.
but I think what I think.
Now do you have to pay the 1% every?
No. So it's only if the property is, sold after the 1st of July, then that property enters the reform. So exactly what you're pointing on now, a lot of different properties will be at different stages in this tax reform in the coming years.
And I think the advantage, to try and answer your question, is so when you first buy the property, you're not really getting anything there because you're paying stamp duty, but if you're a subsequent purchaser of that property in that 10-year period, you're not paying stamp duty, but then at the end, so depending on where you are in that 10-year period, you will then start to pay the annual tax.
So it makes it slightly more attractive as a property to buy, so easier to sell.
Yes.
But if you're going to hold it long term, I mean, if you pay stamp duty now before the 30th of June, you've paid stamp duty and there's no tax forever, for as long as you hold that property.
No tax for
No
Because
tax,
it won't enter
for as
the
long as the
regime.
property. But if you settle off in July, you only get 10 years. So stamp duty used to be for the life of your ownership. Stamp duty is now only for the first 10 years of your ownership.
For commercial.
For commercial industrial properties, yeah.
And Ralph, how is that tax calculated?
So surprisingly, it's a fairly simple tax calculation. So it'll be taxed at the flat rate of 1% of the unimproved value of the property. So no need to get a tax accountant or an advocate to try to figure it out. It's pretty straightforward.
Now, the government, I guess, is trying to get people to transition, I think, early into the scheme. What sort of initiatives are they offering to assist people to do that?
So exactly what we've raised now, there's a lot of considerations. You can pay stamp duty now and then don't have to pay tax for the rest of the time that you own the property. But what the government is offering at the moment is a transition loan. So for those purchasers who purchase a commercial industrial property after the 1st of July and they fall under the reform, and then they have to pay that final stamp duty, the government is offering a loan to help finance and spread that cost out over 10 years. Now, a few of the terms of the loan is you have to be an Australian citizen or permanent resident, Australian company. You have to be approved by approved lenders, like a bank or whatnot. And we don't have the exact terms, but what the government has assured us is that the interest rate will be based at a commercially market-based interest rate. It will be over a period of 10 years. You can repay that loan early, but there'll be some breakage fees. If you sell the property within that 10-year period and you haven't paid off the loan, you'll need to pay it out at settlement, etc. So it's really a type of incentive to try to get people to enter into this new tax reform. And we'll get more details about the particulars of that loan later this year.
So this commercial and industrial property tax actually won't kick in for 10 years after 2024?
Well, if the property, if a particular property transacts after the 1st of July, then 10 years of no commercial property tax, and then after
No,
that.
I'm say in 5 years' time I want to buy a commercial property.
Mhm.
Which tax am I going to be subject to, stamp duty or commercial industrial?
It'll depend.
Yeah, so
Or
the
both.
famous legal answer is it depends. If you're the first, it's the first purchase after
Yeah,
1st of July, then you will pay stamp duty.
Yeah.
And then there's the 10-year period.
Yeah.
If you're say someone else buys it and then you buy it a couple of years later,
Yep.
you'll have sort of, you might have 7 years
Some
where you're not
transition
paying
period.
anything, then you'll start paying the annual tax.
So it'll be a relevance factor when you're looking at properties to buy, really.
Julie, can I just make it a quick, because just with the unimproved land, it's 1 January 2026, and they look back in the last 5 years, and it applies to only certain land in metropolitan Melbourne. There's special rules, so that you've got 5 years not to worry is not correct. Yeah,
Thanks a lot.
that's all right. No, sorry. So I just thought about, and it applies to only residential land. So there's still a lot of details still coming out about that unimproved land, but it definitely is something to be mindful of.
I was just sitting here much more relaxed.
No, sorry. And I thought you were, and I thought, no, I've got to, sorry about that, Julie.
That's all right. So I guess one last thing to sort of tie that all together. There are exemptions and restrictions. So existing land tax exemptions will apply to the annual commercial and industrial property tax. My understanding is like land tax under the Retail Leases Act, you will be prohibited from passing that annual tax on to tenants. And there's also, I believe, discussion about whether the ability, I guess, to pay the annual tax as a one-off payment or a payment plan over the course of the year. Sarah, you have a question?
I've got a question online. My father is 93 and moved into aged care last December. He wants to keep his home until he passes away and likes to visit it regularly, but it sounds like his principal place of residence is now aged care. Does he have any exemption for the unoccupied tax, and does the 6-month period of non-occupation start from January 24?
There are special rules about...
There are some rules about former principal places of residence, so that's probably a question that we can take offline afterwards if the person's happy to send through their details and we can come back to them. Because that's, I think, a specific question.
Yep.
And special rules do apply.
Look, it's certainly the case for land tax at the moment. Whether the new regime has the same rules is another matter.
There is
But
different
aged care can be very different.
Different,
Yeah,
yep.
landscape.
Shall we? The back.
One.
So the commercial property land tax can be paid by tenant as well? Is that covered by our 100% outgoing?
So
I don't
I think,
that was covered.
so I guess what's mooted, my understanding is it'll be similar to land tax, so you should be able to pass it on to a commercial tenant if your lease provides that, but not a retail tenant.
But isn't it a reformation of stamp duty, which technically is not including the lease document?
Well, so it will depend on what the lease says, obviously, which is another consideration, I guess, if you know that tax is coming up because you've owned the property for a couple of years, just making sure that you have that ability to pass it on to a tenant. So it will depend on the terms of the lease. But my understanding is, like land tax, under the Retail Leases Act, you won't be able to pass it on to a tenant. All right, I think it's 3 minutes to go, so we might just wrap up. Thank you everyone for coming. Hopefully that's been informative. There's a lot going on obviously in the tax space, so feel free to reach out to us for any questions or queries. And thank you to Rob, Diana and Ralph for a great discussion today.